To begin our conversation, Wharton professor Jeremy Siegel last with us earlier last month and said we were in the third or fourth inning of the boom. Professor, good to see you again. Where are we today? The market is what? The S&P's up almost 4% since then. New records for the Dow, new records for the S&P. Have we jumped ahead a couple of innings? What do you make of everything now?
We have. Yeah, maybe in the sixth now.
That was quick.
I mean, my interpretation is these low numbers really show the difficulty of firms trying to get jobs. Not that there isn't enough demand out there for jobs. And I disagree with the president that the unemployment insurance is not having some effect on not taking the jobs. So I think that, and take a look at that wage number, which I think Pete also talked about. I mean, 0.7% is a huge increase in wage, one of the biggest increases we had, and we still couldn't induce enough workers. So, I mean, I'm really looking. Next Tuesday and Wednesday, we're going to get inflation picture on the consumer and producers. I think those are very important because I really think that, for the month of May and June, we're going to be getting to see the inflation that's going to come from this prodigious monetary and fiscal policy.
Now you're talking about exactly what I was talking to Leisman about this notion, which I'm hearing from people, market participants today in the build-up to preparing for the show, that forget of all this talk about monetary policy being too loose. It's fiscal policy that's too loose. And that's going to lead to a problem for the Fed that it doesn't want to have to deal with. And that is talk about wages having to go up to entice people back into the workforce, a job market that is still hurting tremendously, which is why it doesn't want to do anything. But then inflation starts to rise, wages start to rise. It becomes a more permanent problem, and the Fed has to act even though it doesn't want to act. And that's bad for stocks.
Eventually, it's bad for stocks. But, this report delays, in my opinion, the so-called day of reckoning. It gives the Fed excuse, oh, no, we got to go longer with this expansionary policy. I mean, there will be a day of reckoning down the road.
But then how did, wait.
There's no question.
Let me stop you for a second. How then have we gone from the third or fourth inning to the sixth in a month then, if this is not a problem then?
No, I mean, I still, I think we're moving along. I think later this year, we're going to get that really Fed pullback. The market's going to ripple and act scared, and then also say, where am I going to go? I did say, I believe in the next 3-4 years, cumulatively, we're going to have 20% inflation. Price is going to be 20% higher 3 years from now, 4 years from now than they are today. And that, could mean stock prices, wages, consumer prices, and the bonds are going to be the worst thing. Real assets are going to be the best thing. And you're absolutely right. The fiscal policy, that's what's putting the money in people's pockets is the government. The Fed is creating it and putting it right into people's pockets to spend. That's what's going to really explode onto the economy second half of this year.
So then that tells me that I want to stay then.
Exactly, it's hard to say, but they will have to pull back. But then, again, people are going to say, where am I going to go?
But that tells me that I want to stay in economically sensitive and cyclical names, restaurants and travel and all this stuff where people are going to spend that money you just talked about.
Exactly. I would stay there. I mean, we get a little bounce back in tech, I think, because yields did fall down, although, they did come back up.
Professor,
that relief,
forgive
but
me.
I think it's temporary.
I'll come back.